We're exploring a crucial topic for anyone considering new vehicle ownership. Leasing versus buying, loaning, whatever it happens to be. Can you imagine saving hundreds of dollars each month just by changing the way that you think about car ownership? Today we're going to compare leasing versus buying and find out which one actually makes financial sense. If you felt unsure about your car expenses, let's explore the hidden cost behind car ownership. Starting with the basics, if you're already an expert in leasing and ownership, then skip around. It's the reason why we put the timestamps on the bottom. If not, then let's get into leasing. Leasing a car typically involves a contract that's from anywhere from 1, 2 to 4 years, where you make monthly payments and you have the option to buy the car at the end of the lease for its residual value. Buying a car actually involves financing, whether you take a loan to pay for the car or purchasing the car outright by paying the full price up front. If you're interested in having a financial edge when you make these types of decisions, that's what this channel is about. Consider subscribing. So to make the leasing and the loan obviously comparable, what we did is we extended the lease so that it matches the same time frame as the loan. And then the other thing that we did is, because we want you to end up with the asset, in this scenario, you're actually going to lease the car and then purchase it versus actually buying the car outright. And then we're also going to talk about a couple of different scenarios, like if you want to lease, 2 years, 2 years, 2 years versus a 6-year financing option. We're going to compare the two and see which one makes the most sense, not only for a family or single person or married, regardless of your case, which one makes the financial sense. So let's talk about the initial cost. When you're buying a car, you obviously need a down payment, which is typically around 10% on average. If you're leasing the car, this is going to require a deposit, and it's typically about a first month's payment up front. And that can range from $1,000 to $3,000. Again, depends a lot on your income, your credit score, so on and so forth. Then you obviously have the monthly payments. If you finance the car, you're going to have a monthly loan. So for this example, we're going to use a $25,000 car at a 4% interest rate over 4 years. This is going to get you around $464 per month. If you're leasing a car, it's obviously going to get you a lower monthly payment. Keep in mind, since this channel is about stewardship, one of the things that I always see is that people want to lease because they want to get into a car that they can't genuinely afford. So what they do is they get a higher end car so they have a lower end payment just to keep up with the Joneses or status. If that's you, this is probably a warning for you to actually look at the car you're getting and make sure you're not getting it for the wrong reasons. You want to get into a car that is a good financial decision, even if it ends up being the car that you don't dream of or don't want. If you're leasing a Toyota Camry, it might cost around $300 per month for a 4-year lease. A couple of additional costs, both leasing and buying involve a certain level of maintenance. The average annual maintenance cost for a car in the US is around $500. Again, it's more of a lower end car. Lease agreements often include maintenance, but not every maintenance. So it's like a couple of checkups out of all of the checkups that you have to do. Leasing will take care of the bulk of those. However, when buying a car, you do have more control of when and how the maintenance is actually performed. Additionally, depreciation significantly affects buying costs. Cars lose about 20% of their value the first year and roughly 50% after 4 years. So for instance, if you're buying, again, this $30,000 car, it might actually only be worth about $15,000 after 4 years because it depreciated by 50%. There's a great book, one of my favorite ones. It's called The Next Door Millionaire. And he gives this very interesting advice after doing a case study on millionaires. The millionaire next door suggests that buying a car that's 3 years old instead of new. And what this does is it significantly avoids the steep depreciation that occurs the first few years of a car's life. According to the book, the average millionaire spends less than $30,000 on their vehicles, opting for reliable used cars that hold the value well. They typically pay cash to avoid the finance charge altogether and maintain their vehicle meticulously to extend its lifespan. This approach not only conserves wealth, but also demonstrates a very prudent financial mindset that contributes to their actual personal long-term success. By making a smart car buying decision, these millionaires are able to allocate a lot more of their resources towards actual investments in wealth building activities than something like a car that depreciates extremely fast. Now, one of the most popular cars in the US is a Toyota Camry. So let's use this for example when we're comparing leasing versus setting up a loan or financing. The average price of a new Toyota Camry is around $25,000. If you lease the car for 4 years, you might pay around $300 per month. with obviously the option to buy the car at the end of the lease for the residual value of roughly $15,000. Over 4 years, you would pay a total of about $14,440 in lease payments. If you decide to buy the car after you lease, then you would actually pay the residual value of $15,000. Adding the lease payments, the total cost would be $29,400. If you finance the remaining $15,000 over 4 years at 4% interest, your monthly payment would be around $339, making the total amount of financing plus the deal about $16,272. The combined cost, of course, of leasing and then buying the vehicle would be $30,672. If you actually bought the Toyota Camry outright with financing, of course, your monthly payment on the $25,000 loan over 4 years at 4% would be roughly $564. Over the loan term, you're going to pay roughly $27,072. After 4 years, the car depreciated by 50%. Its value would be around $12,500.
Oh no, no.
Here's how the different interest rates are going to actually affect the monthly payment of a $25,000 loan over 4 years. So let's do a 2, 6, 8, and 11. Do it all the way across. So we have 543. And 11 would be 642. So about $100 from this one to this one, and it would take the total value of the car from 26,064 to roughly 30,816. So you're losing about $1,000 per month if you're, in the 11 instead of the 2. So it's obviously important for you to have your credit score buttoned down before you actually get a car loan. Here's how the different interest rates are going to actually affect the monthly payment of a $25,000 loan over 4 years. Let's go over all of the averages here in the US. So the average credit score in the US is about 710. The average loan interest right now is 5%. Depreciation, obviously 60% after roughly 6 years. The residual value of a loan that's cost $25,000 is roughly $10,000. And if we look at the first scenario, which is if you go from lease to lease, right? So we're going to loan the car. We're going to do a lease and loan here. And this is going to be 6 years. And this is going to be a 2-year loan, which is the most common 2-year loan. Lease, sorry. What's going to end up happening? Of course, you have the security deposit plus the first payment. So let's call that $2,500 here. And you're going to have roughly $300 per month for 6 years. And that's going to come out to $21,600. The residual value of the car here is 0 because you don't own the car, right? You're returning it at the end of each lease term. The total cost for you to lease this is the $2,160 plus the $2,500, which is $24,100. And you don't actually own anything because you just spent the money to lease the car. So there's no, obviously resale value. Now, let's look at on the loan side of things. If you said, hey, I want to, and this is an O, by the way, I actually want to buy the car. So we're going to assume the same 10% down payment, which is the $2,500. The monthly payment on something like this is roughly $375 per month for 6 years, or $27,000. The estimated value after 60% roughly depreciation is $10,000. So the effective cost of the car comes out to $29,500. Now, because you still have the $10,000 in equity in the car, you obviously have to do so this car actually cost you $19,500, which is obviously cheaper than leasing in this scenario. So leasing the car for 2 years and then buying it, if we're using all of the same scenario numbers that we used above, what's gonna end up happening is you're gonna have a much lower effective cost, about $16,000, compared to taking the 6-year loan from the start, which is $19,500. Continual leasing over 6 years results in a much higher effective cost, $24,100, compared to taking a 6-year loan from the start, which has cost you roughly $19,500. The lease to buy approach provides the most flexibility and of course offers the lowest initial monthly payment, which for some people can be beneficial in the short term. But if you're planning to keep the car long term, you might want to look at different options. Continual leasing obviously has its advantages, flexibility. You're driving a new car every 2 years. It's actually the most expensive option overall though. So take a look at your needs, evaluate your financial situation, and plan on how to best use the car before making a decision. Now, if you guys want more scenarios, for instance, you do a 4-year lease essentially and then a 2-year, I did some of those below in the comments, so feel free to check those out. And stay tuned for the next video where we're going to do something very similar to this, which is obviously buying a house versus renting. God bless you guys, and I'll see you on the next video.